Hello, welcome. Thank you for joining us. We've got a great session planned just for you. We're going to talk all about our market outlook, some planning opportunities, and it's going to be really cool. I'm your host, I'm Mike Kurz. Welcome to the OverShare Advice and Planning 2024 Market Outlook. If you don't follow us on YouTube, check us out, youtube.com/@OverShare Advice. We are located right here in Frisco, Texas, serving clients virtually as well as locally. I'm the CEO and financial planner, and in 2024 we're going to be celebrating our 5-year company anniversary, and we're super excited about that. This is for our clients and our friends. Please know that this is not advice. These are not recommendations. Make sure to read all the disclosures as you move along through the presentation. We're going to talk about how do we gain better outcomes with gaining perspective, some ideas for portfolio constructions, details for you that matter for your future. And we're going to hear from the smartest people in the room. We're so lucky that the world we live in today, we have access to information, access to intelligence, that we can borrow this mantle of authority and hear from folks all across the globe. I love it. We're going to hear from a lot of folks. We'll share a few stock market surprises that are just kind of cool, and a few bonus takeaways all about the election and the markets. This presidential election we're starting to think more about, I think, is really cool. I know we're not supposed to talk about religion, sex, or politics, but we're definitely going to talk about the election and the markets. And if we have time, maybe we'll throw in the other one. No, I'm just kidding. That's all we're going to do. Well, let's get into gaining better perspective for better outcomes. We'll start right here in the U.S. with the equity market, specifically U.S. large cap. Let's take a look here, and I'll get my highlighter so that we can take a look easier, going from 96 to December 7th, 2023. This is the price index for the S&P. What does that mean? It doesn't include dividends, but you can see what that has been, the performance of that index, those 500 largest companies here in the U.S. I can tell you this bottom down here, that week of March in 2009, after the market has been very ugly, that global financial crisis. I can remember being in downtown Indianapolis on the 11th floor in an office building, presenting to a group of financial advisors, and it was a tough conversation. It was a very tough conversation, but thankfully they stayed the course, they worked with their clients, they did a great job, and because of that, they were able to experience with their clients some really nice equity markets. Certainly we've had some volatility caused by a variety of things the last few years. We're going to talk more about that, as well as the expectations going forward. Now let's look at the markets a little bit differently. Let's take it 1 year at a time, because that's how we often think. That's how we often gauge. That's how we often measure, is 1 year at a time. And let's look at 43 years going back to 1980 through December 7th, 2023. 32 of those years ended positive, but you can see with these red dots throughout the years that during the year we've had a red dot or a drawdown, a drop every single year. And in fact, on average, 14%. What is that telling us? That's telling us in order to get these nice up returns, these nice bar graphs, we have to survive or endure the difficult periods. This is why we get paid. We get compensated in returns for taking this risk. During this period, these 43 years, it's an average of over 8%, actually 8.7%, looking at the S&P 500 or U.S. large stocks right here in the U.S., which so many of us have big exposure to in portfolios, and we'll show you actually why that is here in a little bit, because we'll look at a map of the markets, which I think is gives you a little more perspective, and it's very interesting. Our good friends at Goldman Sachs sent us this summer, because it was all about the markets, all about the S&P, and specifically what was driving the first half of the market. But they also threw in a little bit of additional feedback. We know that these large companies have been in the news recently, but let's take a look back in 2000. The five largest stocks in the year 2000: Microsoft, Cisco, GE, ExxonMobil, and Intel. They were 18% of the S&P 500, and you can see that black line of their performance collectively, or percentage of the index collectively through that time period. And then if you look at these five today, they're 24% of the index. Now take a look at performance. Now, instead of 5, we're going to go to 7. In fact, this year they've been calling it the Magnificent 7. That's Meta, which is Facebook, Amazon, Google, Microsoft, Apple, Tesla, and NVIDIA. And if you look at that from January through June, and you look at that performance, these 7 companies, these 7 stocks up 63%, which is phenomenal. It's fantastic. The whole portfolio of the S&P together about 16%. And if you remove those 7 stocks, that reduces the return of the entire S&P 500, those 500 stocks, by 11%, an enormous reduction. Now, we might need to get a little bit more perspective, right? That's kind of like climbing on top of the hill when you may be a little bit lost, just to get a better perspective of where you're at. Now, instead of looking at just going back to January 2023, let's look at January 2022. Those same 7 stocks, those same magnificent 7 in that, what is that, purple, periwinkle, lavender, whatever color that is. And you can see that over from January 2022 to the middle of June, those 7 stocks are actually down. In fact, they're down more than the S&P as a whole, being down 9% during that year-and-a-half long period. What's interesting, we had some good feedback from clients in the middle of the year, and they're like, Mike, man, these 7 stocks have just gone through the roof. It's time. I want to invest in these 7 stocks. We feel like we missed the upside in these 7 stocks. Let's look at this. Our friends at Morningstar put this together. And this looks from January to July, and then from August until October. And those 7 stocks, Apple, Microsoft, Alphabet or Google, Amazon, NVIDIA, Tesla, and Meta, which is Facebook. This big blue bars, look at this. This is 250%. Look at this NVIDIA. Look at this Meta. Look at this huge return in that first little more than half of 2023. And then look at it from August 1st until October. All negatives. Just saying that, hey, this is a difficult market, not necessarily easy to foresee. Some folks really see this upside was a big driver in this tech rally, especially those around things driven around artificial intelligence, which we're going to talk a whole lot more about. We talked about equity. We talked about large equity, U.S. equity. Let's talk about fixed income and interest rates. That same chart that we looked at with the S&P, let's look at fixed income. And you can see a very similar experience. 47 years of history, 42 of those years were positive. But on average, each year you see a red dot. And some of those red dots, if you're a fixed income investor, weren't fun. Most recently, if you were a fixed income investor, my goodness, 2022 was very ugly. And we were fortunate as a firm, we're very light on fixed income throughout that year. Not zero, but light on fixed income throughout that time period. Very fortunate for most of our clients to have that exposure very light. But look at this, down 17% in the intra-year drop in 2022, which is very ugly. Now, if we can have a long-term perspective, we can endure those expectations through that time period from 76 till 2022. You can see 6.6% average return, over 6% average return, which is really fantastic. Certainly these big returns have skewed this first 10, 15, 20 years of outsized returns, skewed that to 6.6. The last 10 years have not been that high, but that gives you a broader perspective of what things have looked like. Now, you hear a lot of discussion about interest rates, in the market about the Federal Reserve and what the Fed is doing. 0.25%, 0.5%. You may hear 25 basis points, that's a quarter. 50 basis points, that's a 0.5%. That's more this blue line. That's these little stair steps. That's what you're seeing in the blue line. But aside from that, the market itself is moving all the time. Interest rates and yields are moving all the time. And that's these two lines that you see, specifically the 2-year and the 10-year. And what's interesting is this 2-year yellow number, this 10-year yellow number is typically above the 2-year. As you would imagine, if you're loaning money for a longer time period, you would expect a higher interest rate in return. That has actually not been the case the last little bit. We call this an inverted yield curve, where the 2-year is actually paying you more interest than the 10-year. And this has even changed since this graph was created in October of 2023. Let's get a little more cool stuff about the markets. I love providing perspective. Did you know, in the terms of the entire globe, all the companies that are traded on stock exchanges, the U.S. is about 60% of that. Here on the charts, the 61%. The rest of the world, about 28%. Emerging markets, Brazil, Russia, India, China, only 11%. A small piece. Now, if you look at this on a map, just imagine what you see, the squares. Take a look at this. Imagine this was a map laid out in front of you. On the left side is the continental U.S. On the far right, you go through Europe, Asia, and Japan. That gives you that bearings where you can get a sense. Here in the U.S., again, about that same percentage. This is as of the end of December, so the numbers are a little bit different. 59% for the U.S., which is about 60%. Canada above us, what we consider a developed market. 3% of all the world's equity market capitalization. You see Japan at 6%. England and the United Kingdom at 4%, France at 3%, Switzerland 2%, Germany 2%, Sweden 1%, Australia 2%. Now if we look at emerging markets in this green color, is that chartreuse? What color is that? This weird avocado kind of lime green color. And you see that China, as much as we talk about China, this world equity market capitalization, now China does things a little different with how they do their stocks. When you're when you're a Chinese citizen versus outside the U.S., but 4% of this world market, Korea, 1%, India, and you don't see some of the other ones. Here's Brazil over there. I've been to a lot of these countries like the U.S., Canada, England, Germany, France, the Netherlands, China, South Korea, India, all these countries I've been to as well. And you can see actually on my desk in the back, I've got fun little artifacts from all those places. As we move through there, now we've talked about the markets, we've got some history, we've got some perspective. Now let's talk about how we actually build portfolios with this perspective. I love this chart. If we take a look at this chart, we can see stocks, bonds, and a 50-50 split between the two. And we look at different time periods. And if you don't know what a rolling time period is, it's worth investigating and Googling. So we see a 1 year at a time. If you just looked at the market at 1 year at a time and you said, I'm going to invest only 12 months at a time, that's a very difficult experience and a very difficult approach to be successful, because you could experience all of these things in a 1 year time period, this negative return, which is really ugly, which we don't want anyone to experience this. This is from 1950 to 2022. Just moving from 1 year to 5 years changes your experience significantly. That range of experiences changes significantly. And you can see this with green, the U.S. stocks being down 3% on the low end, up 28%. This is much better than being down 39%. If we move to 10 years, you can see this range of returns being significantly better, and certainly over 20 years, all positive, big impact. We're seeing, a 50-50 portfolio of over 8% return from 1950 to 2022. This is where we're starting to see, okay, how do we put these things together? What's our recipe? What's our asset allocation? This chart now takes, instead of two asset classes, stocks and bonds, it looks at multiple asset classes, large, small, international, emerging markets, real estate, high quality fixed income, high yield, which means the more risky fixed income, a little bit of cash and commodities. And you can see, if you imagine putting all of these 9 asset class boxes together for one diversified portfolio, much like individual band members, individual instruments, putting the band together, trying to make beautiful music, we're trying to make a smoother experience for clients and still getting a good return. And you can look from 2008 to 2022, this asset allocation of getting about 6% annualized return without the huge volatility of other things. How does this work? Why does this give us a lower volatility and still give us good annual returns? This is all about correlations. We think of how these instruments sound together. Now, it's more difficult with investments because we can't use our ear to listen and hear the sound and have that tone, but we've got to use numbers. The numbers on the chart give us our feedback and our understanding, whether it's 1 being a very high correlation, at 0.5 being low, a 0 being no, and then a negative being a negative number being a negative correlation, means they move opposite one another. Now, when we're building portfolios, we work with our clients and work with our friends and families to do this portfolio construction. How do we actually pick and go about picking these managers? And where's the risk involved? Where's the struggle involved with doing this? And so I love this chart because this first one, these are U.S. funds, global equities. These are investments that you can invest in. Top quartile versus bottom quartile, not the very best versus the very worst, but these quartiles, so that gives us a range. And you can see the ranges are pretty tight. This dispersion of returns for the managers is actually pretty low, which means when you're picking mutual fund managers, you're picking ETFs, you want to pick good ones, certainly. You don't want to be the very worst. You don't want to accidentally get the worst because you were chasing the very best, because sometimes we see that happen in the marketplace. But good returns, good solid managers give us really right in that median of good returns. Now, to the far right of this chart, the world is different. It's very different. So now these are private alternative investment managers. So global private equity, venture capital, hedge funds. Look at the range of returns on these. Look at how much different from top quartile to bottom quartile. Not only is this difficult to access, it's difficult to get great managers. It sometimes takes a huge amount of money to gain access to managers. Now the world's evolving a bit, so we can get more access to some of these great investments in private equity or private debt throughout this category. Did you know that the top 25 private equity managers, the top 25, because there's hundreds, the top 25 manage 1/3 of all the private equity assets. So the best managers do get the lion's share of the assets, and they're also the most difficult to get into. Alternative investments definitely is a different animal. All right, let's shift through some of those things that feel a little out there, feel a little harder to grasp, feel a little harder to put our fingers on, feel a little harder for us to maneuver. Let's talk about things we can do, things we can actually have an impact on that make a difference in our portfolios, a difference in our savings, our retirement assets, a difference in our future retirement. Certainly, these are the things we just talked about. A lot of those are out of our control. What the market does, how much taxes we pay on those market gains, all right? And now look at things that we can control. This asset allocation that we talked about, that's that recipe that we looked at, or asset location. Where are these assets? What does that mean specifically? Do we have an IRA? Is this tax deferred? How much do we have in the tax deferred account? Are we looking at a Roth IRA for tax-free income? What are we doing with our 401k? What's the mix of these assets, and how are we taking advantage of the location? Certainly we can control our savings and spending and understand what that is. And we're going to look at these two areas, this longevity, employment earnings, and duration, how that impacts our future. I love this chart. I get a lot of questions on, younger folks saying, hey, where should I start? Where should I get going? I'm looking for long-term retirement. This is not short-term. This is not, hey, I'm saving for a house. from saving for a car, saving for a piece of land. This is long-term retirement savings. So certainly everyone needs that emergency reserve. You need to max out your employer match and things like your HSA and your retirement plan, pay down your debt, go back and maximize that contribution in your retirement accounts, pay it down these other debt, do an IRA. If you don't know what a non-deductible IRA is, or a backdoor Roth or a backdoor Mega Roth, those are all G-rated. I promise, you can Google them. And those are opportunities as you move up that ladder and fill those buckets. And certainly building a taxable account long-term for your retirement gives you some flexibility as well. We call this kind of the tax triangle of taxable, tax-deferred, and tax-free. There's other opportunities, annuities, certain insurance products, certain types of life insurance can give us some tax-free benefits as well. Just got to be very careful how we navigate that, but those are some opportunities. What was the other thing in the graph that said we have some control over? Do you remember that one? That was longevity. Now, when we talk about life expectancy, so often what's in our heads and what we hear in the popular press is life expectancy for a baby. Now, I have a niece and nephew that have a brand new baby that's about to turn 1. When you hear in the news, hey, life expectancy is now 75, it's 77, it's 80, that's for a brand new baby. Now, what if you've turned 65? That changes your probability to reaching 85, 90, 95, 100. And if you're a couple living in a home together in a household, realize you have a 90% chance. 90% chance that one of you will live to age 85, a 73% chance to live into age 90. So those are very important. That then transitions into our Social Security retirement benefits and how do we claim these benefits? What's our strategy building this around? There are choices that you can make, and there's an impact of those choices. This number here, take a look, FRA stands for full retirement. So this FRA is an important number. Full retirement age. So we're looking at age 67. This is an example. This is complicated. Don't think it's super simple. There's a little moving parts. This is assuming someone born in 1961, full retirement age of age 67. If you retire at your standard age, this is this gray line. This is what you would expect in a monthly income for a couple. And then that's about 1.5 million over that time. But now if you start taking early, like, hey, I can get benefits as early as age 62. That's 5 years earlier, but you get a lower amount. In fact, because you get that lower amount throughout your life, instead of 1.5 million, we're talking about 1.2 if you live to age 90. Now, did you know that you could also delay Social Security? And as you delay Social Security, it increases your benefit. So if you delay to age 70, you can see that benefit here. This is if you're a friend of or a fan of William Wallace and you've watched his movies, Braveheart, this is when he's saying, hold, right? You're 62 and you can take your money, you're 65, 67. He's saying, hold. Why? Because during that lifetime as a couple, we're talking about $1.7 million in Social Security benefits. Now, I get it. If you're 65 today or close, you're likely going to get those retirement benefits. If you're 45 or 35 or 25, you're saying, I don't think it will be there. We don't necessarily agree with that. We won't say there'll be zero, but certainly the Social Security calculations of your benefits in the future could be different. Taking Social Security and while you're working could be, right, that's taxable today potentially. You could have a reduction of benefits potentially. Those calculations of future could be very different. How much you pay in could be more sensitive in the future. How much you pay in through your lifetime could be a greater sensitivity, as well as what's your current income and assets today. It may be more needs-based or means-tested, which saying if you're a very, very wealthy person, you may get a limited amount of Social Security compared to what you paid in, or someone else at your age paid in the same, may get a higher number. Lots to think about. We could talk about Social Security all day, but I love this chart. You have choices, and there should be a strategy how you've gone about this. And I will say it's interesting. I just had a conversation a couple of weeks ago that said there's some interesting research now that says, how are people choosing to claim this? And I hate to pick on my other friends that are advisors, but they're telling us that sometimes what they see is a lot of folks that have advisors are choosing to take early. And the downside of that is, you could potentially be reducing your benefit. At the same time, we have to look at this and say, why would an advisor to tell you to take that money early? Because if you're getting income early, you're not taking money out of your investment account. So we have to be careful that make sure you work with a good advisor that gives you both the good, bad, and the ugly, that is very transparent, that helps you understand these choices, does the numbers, that doesn't just back the napkin and shoot from the hip, because these are big numbers. We're talking about $500,000 difference over your lifetime for a couple, so please be aware of that. That's an important thing. Now, if you're looking at, hey Mike, I know I've done a big financial plan in the past, but I'd love a quick and easy way to say, am I close? I don't want to have to redo a financial plan every single year, or maybe I'm 35 and I'm not quite ready, or I'm 25, I'm not quite ready, or I'm 45 and I think I've done really good. Give me a ballpark idea. This is a great chart. Happy to send it to you. And you can do the math over here. And just for fun, it says, look at your top, imagine your household income. If your household income is $200,000 a year, and let's say you've already reached age 65, now you take our little number here and multiply that, that's that 10.9, and we're saying 200,000 times 10.9, that's a little over 2 million, about 2.1 million, and they're saying that's a good starting place, a good estimate of the assets that you'll need going in at age 65, and so that's a good chart. Happy to send that to you as well. All right, I told you we're going to have a lot of good stuff. We got more good stuff. Planning opportunities. I know it's getting close to the end of the year. You've got a little bit of time. Make sure you check a few things. Certainly in 2024. Start now. Planning for 2024. Your 529 plan contributions, don't miss those. Salary deferrals. Make sure you look at your payroll for those deductions from your bonuses. Make sure you understand your contributions. Are you contributing? Does your company recently added a Roth 401k option? That's pretty new the last few years. If you haven't looked and talked to your HR person, you may be missing out on opportunities to contribute to a Roth 401k that grows and potentially is taken out tax-free. We like that. Gifts for family, friends, charities. You need to write those checks before the end of the year. If you have a donor advice fund, what some people call a DAF, DAF, make sure to do that if you contribute to private foundations. Capital gains and capital losses are important to manage throughout the year, not just at the end of the year. Be managing those throughout the year. So start now thinking about next year. The investments that you own could have an impact on that. If you have mutual funds that spit out a lot of capital gains, you may be paying taxes on things that you're not actually getting an economic benefit from, which means you may be paying taxes and writing a check that takes money out of your investments and not actually getting a return for that. Happy to explain what capital gains are or embedded capital gains. That's a longer conversation. You just have to be careful from that. Make sure your taxes and your withholdings are calculated correctly. If you've had to pay out money the last 2, 3, 4 years because maybe you're making more money and you're in a higher tax bracket, it may be time to increase the amount of your tax withholding on your payroll. If you're at the stage that you're taking money out of your IRAs or you've inherited an IRA that requires you to take money out, those RMDs are important. We've worked with clients in December, this month, to make sure to get all of those taken care of. I love going out and visiting with clients. We have a limited number of clients, so it allows us to do really great, cool things, drive and go see them, visit with them, making sure we get all the paperwork signed to make sure everything makes sense. And we can do that. I love being able to do that. Make sure if you have an FSA, if you have use it or lose it money, don't lose it. Make sure to use it. Now this is a big one. We are not an insurance company. We're not licensed to sell insurance. But right now is a great time to be reviewing all of your life insurance. Think about that in Q1. If you've had changes in your life where now maybe your kids are older and you no longer have kids at home and you no longer have the need to protect their savings for paying for their college, you may not need as much life insurance. If your mortgage is almost paid off or is paid off, you may not need as much life insurance. You could talk to your insurance agent about reducing, especially for permanent insurance, reducing the life benefit, the death benefit on your life insurance. And that could potentially increase your future cash value. There's still some options there. If you have disability through your company and you're increased your compensation, so maybe a few years ago, maybe you've doubled your compensation. Does your disability truly protect you? A lot of disability policies have a $10,000 cap, $10,000 a month. You only get paid 60% of that. If you're disabled, that's $6,000. Then if the company is paying for the premium, you have to pay tax on it. So could you live on $6,000 minus income tax if you've been making 20 or 30 a month? So make sure to look at disability, or if you need other things. If you're at the age, if you're hitting 50, just like going to the doctor and it's time for the colonoscopy, it's time to be thinking about long-term care and understanding how does long-term care insurance fit into your overall strategy and financial planning. Home prices have gone up huge in the last 5 to 10 years. Make sure your homeowner's protection is good. Your auto protection is the same. If you maybe bought a recent car and the cars have been really expensive lately, and you had other insurance options that maybe you don't need anymore, make sure to do that. If you work from your home nowadays, and if you have a lot of computer equipment, or you've bought jewelry, or you bought other items here in Texas, if you bought guns and you want to protect those and you're comfortable putting those on your home insurance coverage, all those things, be careful of. All right, let's talk about the smartest people in the room. What are the smartest people in the room telling us? One of my mentors, Al Jackson, I started working with over 20 years ago, he used to tease, I love it, he would joke around and say, I'm the smartest person in the room and I don't understand it. And I love that feedback. Sometimes we do have to be humble. We do have to take a perspective and listen to others. We are so fortunate to live in a world where there's so much great intelligence at our fingertips. We do a ton of research here at OverShare Advice and Planning. I read a ton all the time, always downloading and reading. We look here on our screen. We have long-term capital market assumptions. This is not just what's happening today, next month, or next week. These are typically 10-year projections. And JP Morgan, BNY Mellon, Northern Trust, as well as Dimensional Funds, a company that was in California that moved to Austin a few years ago. Like, my goodness, like a lot of people. So let's dig into this. I've got a lot of cool stuff. We're just getting into the details of the market outlooks for 2024 and beyond. We'll talk about what JP Morgan's saying and share with you there. Certainly as we're moving from, as JP Morgan talks about, moving from this conventional or this tighter or more easier monetary policy, moving to more conventional, more tighter monetary policy and fiscal tools. What does that mean? We're going to talk about that in just a bit. They see complications in the energy transition. They see complications potentially from new technologies. What's new technology? Artificial intelligence, that's for sure. They see China potentially in this real estate bubble. Some of the risk, debt sustainability, specifically here in the U.S., and potential debt default is always a risk. Extreme weather events, Russia and the Ukraine expanding their war in other places around the world. Tension with China, specifically tariffs. Challenge to the U.S. dollar as the world reserve currency. If you don't know what that means, I'm happy to visit with you and tell you that can be a larger impact, but maybe not devastating. And the next they look at is potentially, whatever your opinion is on the pandemic, a secondary pandemic or vaccine resistant strains. Now, whatever your choices is or your beliefs of what you believe in your household, what you choose to do inside your body, outside of the house, there are people that make decisions. If we had a secondary pandemic, there are people that make decisions that could impact our financial world. And so that's why we're talking about one of the risks there. Another one, risk specifically if inflation stays high, that could keep rates too high or too high for too long. And I like that JP Morgan mentioned that. They talk about QT. If you remember QE, quantitative easing, that's several rounds of that. QT is not going to the local convenience store for an icy and some snacks at QT, but QT is quantitative tightening. And think about these central banks cleaning up their balance sheet. Think of your own household. If you say, hey, we got to tighten the budget, That means less money, spending less money. So that could certainly be a risk. Upside, what they're talking about here for JP Morgan, European energy independence, AI driving productivity during a labor scarcity, which they think is good. Corporate investment, they feel, is driven productive capacity and upscaling of labor. If you haven't learned about the U.S. Chips and Science Act and the European Chips Act, it's very interesting. The world of semiconductors has really expanded, almost exploded in a huge way. So if you're not familiar with that, it's certainly worth taking a look. It's good to hear from our folks at JP Morgan. The next one, BNY, a lot of similar themes. Certainly they look at 46 asset classes through 10 years. Their themes that they are seeing: number one, the aging population. Did you know in the next 30 years, folks over age 65 will double? I can tell you in the next 30 years, I'll be over the age 65. A lot of you, if you're watching this video in the next 30 years, you will likely also be over the age 65, and probably much higher than that. The next thing, they see rates higher for longer. They see AI certainly being an impact on productivity. I love how they wrote this. I think BNY chose their words carefully when they say green energy from policies. Green energy, right? That's a lot of EV and electric vehicles and other things. Green energy from policies. They're not saying, hey, it's better. They're not saying, hey, it's better for the environment. They're not saying, hey, there's a demand for it. They're saying, hey, policies, government policies may dictate the green energy, which I agree with. The next thing they talk about is deglobalization. If you've gone to business school or you went taken an investment class in the last 30 years, you learned about globalization. How we get so much things here in the U.S. from outside the U.S. and other countries shipping things to us. Deglobalization is now this transition of, especially these emerging markets, now buying their own goods internally, manufacturing their own stuff, buying their own stuff within the borders of their own country, this idea of deglobalization. Both BNY and JP Morgan, I thought was interesting. They cite this idea when you're looking at the portfolio of a robust portfolio construction. The last 30 years, we used to use the word optimal. They have switched that to use the word robust, not just an optimal portfolio, but a robust, saying really more flexible, more dynamic, more opportunistic, more ability to adjust, let's say, on the fly. If you're a sports guy, you know what that means, right? This may be a where you can call the play as you're getting ready for it and adjust as you're getting ready to make the play. As we move forward, Northern Trust, I love Northern Trust, what they do. They had a lot of similar themes, so I don't have to recite all of Northern Trust. Certainly debt and demographics are two of the things they cite as potential issues. Geopolitical fault lines, my word. We should all know that. In equities, they see solid revenue growth. They do mention, they go on to mention concerns about falling profit margins, which I agree, something that we have to watch carefully. And the last one, to mention on the far right, not your typical capital market assumptions. Now, this is a group that moved from California to Austin that we talked about, but they have a lot of connection to Chicago and the University of Chicago and Chicago Booth. But they do look at things a little differently, and they are very mathematic, very practical in their approaches, and I really appreciate what they said. And they're not your typical capital market assumptions, because it was really a cautionary tale. And their cautionary tale says estimates going the next 10 years, hey, they're likely wrong. Be humble, right? There's a lot of noise, so there's a lot of errors in these average returns. Focus less on trying to be exact and guessing. The next 10 years, focus more on this range of possibilities, and focus more on that range of possibilities and how you navigate that, which I appreciate that feedback. I like what they've done. Goldman Sachs, everybody knows the name Goldman Sachs. They do a huge company. They do a lot of really cool stuff. We'll talk about them. A little bit of the Federal Reserve. We've heard from BNP Paribas. If you're European, a tiny bit from Morgan Stanley. But Goldman Sachs, my goodness. Again, similar themes, a lot of similar things. So I'm just going to pull out from their report some things that are different. I do like how they say, hey, with portfolio construction, you're going to have to think differently. But I will tell you, when they say think differently, it's really a lot of the things we've been doing the last 10 years. So not too differently. They talk about fixed income and they say, hey, it's time to upgrade to quality. Same thing. We've been talking about upgrading to quality for a while. Why is this? Because interest rates have been low for so long. In fact, we talked about it's described as a zero interest rate policy, a ZIRP, Z-I-R-P, that you can Google. Great name. And in that zero interest rate policy, interest rates have been so low, folks have really had to struggle to get income and yield, get a better return on their fixed income. So what do? They got lower and lower quality. Because the lower quality, the more risk. And because of that, they could get a higher return, a higher interest rate, a higher coupon. Now's a good opportunity that as interest rates have gone up, take some of that risk off the table and replace it with better quality, which I 100% agree with. On their equity, what they see is increased dispersion among stocks. So kind of like that graph we looked at in the top to the bottom, a wider dispersion in stocks. We look at that Magnificent Seven. Certainly that's what we see as a large dispersion. They feel also that micro, right, looking at the individual companies going forward, the company's specific factors is likely to be more important than the macro. Now, it may be because as a firm, they offer a lot of actively managed investments that do this thing where they hire managers to pick stocks. So maybe that's why they say micro instead of macro. I will say, as an individual, as a portfolio manager, that's a much more difficult thing to do. Some of the countries they like: India, Japan, Mexico, and Vietnam. I will say, as a firm, we invested in Vietnam early, a few years ago. Early, if you don't know, the old joke that portfolio managers and hedge fund managers were never wrong. We're just early. We were early to buy it before it returned, early to sell it, and then it goes up. So that's the old joke. So we did get some Vietnam exposure to our portfolios just a bit early, which was wrong. It didn't return that great. So, but I like hearing from Goldman Sachs that they're seeing opportunity there. We talked earlier about the world reserve currency. Goldman Sachs says this could be a de-dollarization transition period where there may be a common currency, probably not just one currency in their expectation, but maybe a common currency from several countries pulling together. If you don't know the BRICS, B-R-I-C-S, Brazil, Russia, India, China. What does the S stand for? Well, it's not South America, it's not South Carolina, it's not Spain, it's not Singapore. The BRICS and a potential common currency is South Africa. So that gets you there. And certainly they talk more about AI and how to use AI. I love their specific examples that they put in their research. AI for precision medical. And they talk about specifically that, hey, if you look at AI, they think that technology has a better opportunity than human beings to anticipate the difference between a real heart attack and a false alarm. And that's real things that can make a difference to real people. They also make a discussion on knee replacements and that potential artificial intelligence can help monitor pain, that it could help monitor motion and flexibility and range of flexibility so that doctors can do a better job and nurses can do a better job with your recovery. My good friend Bob, say hello to Bob, he just had a knee replacement this week. So I know that he's probably wishing that this artificial intelligence was already there. But we love that as a possibility in the future. This BNP, it's interesting. It's more European take. They were very open and very honest. If you see that one there in the middle, BNP Paribas, if I'm saying that right, for our European friends. And with what BNP is telling us, hey, volatility is the new norm. Get used to this. If you thought volatility was big in the past, it's going to be higher. They also look at profound, unanticipated change. They're saying, hey, we don't know exactly what it is, but we know that we could be careful about this profound, unanticipated change. That could be geopolitical, that could be AI, all those things as part of that. If you've ever read about Nassim Taleb in his book called Black Swan, take a look, Google it, what a black swan is. It's not always a bad thing, but it certainly could be a profound, unanticipated change. The internet is one of those. The internet, how it has changed our lives over the last 30 years, is one of those black swans. Certainly AI could be one in the future, but we will look at that. Some of their other things they talk about is tighter rates could be tough on growth and tough on profits. They love innovation from artificial intelligence, and I love their choice of words. This is such great corporate speak. They use the word creative destruction for artificial intelligence. What a great way to turn a phrase. Creative destruction. They like fixed income. Specifically in fixed income, they like longer duration, and they're cautious on equities. Morgan Stanley we read a short report from Morgan Stanley. We don't have any connection to any of these firms. We don't have any ownership in any of these firms. Morgan Stanley talked about being overweight quality fixed income, which we've heard. They're talking about being overweight Japan, underweight emerging markets, and underweight commodities. Now, I'll tell you, we've been underweight commodities as a firm for a while. We were also early in that. What does early mean? We were wrong. We were underweight commodities early and also wrong, which that happens. That's part of the change. If you're not as familiar with AI and artificial intelligence, how it's used, this is a really cool chart. Talks about, hey, functional AI for robots, analytical AI for understanding analysis, interactive AI for chatbots and smart personal assistants. If you have an Alexa, that could be artificial intelligence could help this interactive AI. If you talk to Siri, that could be the same thing. Text AI, like text recognition or speech to text conversion. Visual AI, this augmented reality or computer vision, we think is cool. What helps self-driving cars? That computer vision. Other uses for AI: decision making, complex problems, increased accuracy, performing high-level computations. If you're not familiar with quantum computing, I sat with a client just a couple weeks ago and had a great conversation talking about all kinds of things. I'm still trying to learn what quantum computing is. I've read all the definitions and watched all the videos, but it is fascinating. If you haven't Googled it, check out quantum computing. It's a very interesting topic. All right, we've got more. As we move through these, we'll go a little faster and skim through some of these as we get some cool, interesting things. T. Rowe Price does a real nice job. I like what they put together. But the big takeaway from their report, their entire report that I took away was there's not one solution that can completely fulfill your retirement investment needs. There's not an investment, not a mutual fund, not an ETF, not an annuity, a life insurance product, or other insurance or other structure product that is going to solve all your retirement things. This is an ensemble cast necessary. This is not one instrument or a two-piece band. This does take an orchestra, they feel, to really navigate that, and I love how they put that together. PIMCO, huge bond shop, and they say, hey, it's prime time for bonds. Luckily, they're not the only folks that's saying that. We also agree that it is getting more attractive now to go back into bonds. Maybe even bond funds, actively managed bond funds or ETFs could be more attractive today, certainly, than they have been in the last 2 years. Merrill Lynch talks about, hey, make sure to be diversified to protect. Be careful of global conflicts and these cross currents that could impact markets. And I love they put on here, fall in love with fixed income again. And so everybody's loving fixed income now that rates are much higher. Now that it looks like we're more stable in our place. And so that's something that you're hearing more and more. If you take a look here, Fidelity, this is not just Fidelity US, but Fidelity International. They're very interesting, and they think that interest rates will peak throughout 2024. They do think potentially because of these high interest rates that could stall growth. That's something we have to watch out for. So Fidelity did a nice job and gave us 4 scenarios, and you can Google this. This is all free to you and access. You can Google this and find out there's 4 scenarios. Number 1, the most difficult and the one they think could be the most tough to navigate through is the balance sheet recession. We talked about quantitative tightening, that QT, not being a trip for an icy and a snack, but QT, tightening our balance sheet, tightening our belt, could be the toughest. A cyclical recession, which is more normal, going to a soft landing, which is hopefully what we've seen, and a potential no landing, which is the very best scenario and the highest returns, which is probably a little too optimistic as we navigate the future. Citigroup. Now, the head of wealth for Citigroup is a gentleman named Andy. Andy was at Citigroup for years, then went to Merrill Lynch for years, and just recently went back over to Citi. I like their wealth outlook. It's huge. It's a lot of pages, just like J.P. Morgan's. I think J.P. Morgan was 150 pages. The wealth outlook for Citi is really large, but I like what they did. I like how they put together. If you're a reader, I would certainly recommend taking a look at that. Some of their things that they looked at is they believe the future is, in their words, slow then grow. Slower to get going, and then they see some growth in the future. They do like core portfolios. That's the 60-40 portfolios. They have a top 10 in there. You can go and read about their top 10 investment ideas. I'm not going to read all of them, but a few of them. Number one, semiconductors. We talked about that earlier. Semiconductors, number one. Two, because of AI, cybersecurity. Number three, energy. I won't go through all these, but they talk about medical technology and AI, defense contractors, because all of this global issues that we're having. Japanese yen, specifically financial and technology, and certainly the yield curve potentially changing. Merrill Lynch up here, we talked about T. Rowe Price. I think we hit all of these. A lot of good stuff. We're kind of rounding out. This is our last page of research to review. Now, if you look on the screen, these three firms are all enormous, multi-trillion-dollar firms. Vanguard, BlackRock, and State Street all have a huge impact on the world we live in ways that most of us don't even know or aren't even aware. But large firms that work with a lot of companies. Vanguard, I'm just going to hit a couple of the highlights there. That Vanguard's, they're saying, hey, bonds are back. Equity valuations, be careful overall. They're saying, hey, maybe be more defensive. BlackRock, at some of their things, they have this mega forces, which they talk about. It sounds a little bit like a Lego movie, but mega forces I love, and the AI certainly is one of those themes. In their portfolios, I like the words that they chose. They said, be dynamic and be nimble. Over here in State Street, they start off their report with the words, enthusiasm is common and endurance is rare. And you can see that at the top of the page, that quote from Angela Duckworth, enthusiasm is common, endurance is rare. And certainly with the markets and being an investor, it does take endurance to get those best returns, to make it through the difficult periods, to get paid, to get compensated for surviving those difficult periods, to enjoy the good news and the good weather. They looked at a couple of their things, growth with quality as their focus, an emphasis on stable income. What's different that they mentioned compared to Goldman Sachs, they're saying, hey, look for new opportunities through momentum. They like the macro view, like the large index view, the large country view, versus the micro view that Goldman Sachs had said, where you said pick individual companies. Now, I'm a little skeptical, so maybe the difference between one and the other is because State Street has a lot of index products that are very macro driven, and Goldman Sachs has a lot of portfolio manager offerings that are individual stock driven. But I'm a skeptic sometimes, but we do have to filter all of these things and read between the lines, understand who the message is coming from, so that we can then put that in our own views and work with clients. Goldman Sachs talks about oil being between 70 and 100 in 2024. I think that's fair. I think that's also a huge range. That's like saying, hey, I don't think they really went out on a limb. That's kind of like saying, hey, I think the football game is going to be between 10 and 40 points. So not to tease our friends there too bad. And they said, hey, the global economy, we think, will perform better than many expect in 2024. So some opportunities they see there. My goodness, we have covered a ton. We have covered so much. Are you still with us? A lot of good stuff. I hope you've enjoyed it. I took this picture in Vermont not long ago on a wonderful trip, and that's real. That is not touched one bit. That is not photoshopped at all. Standing on that hill one beautiful morning with huge clouds in the sky with a little bit of sun peeking through in the background. And it was a beautiful day. I was so glad to take that wonderful picture. We're not going to go super detailed on these, but just interesting. If you take a look at these, we're saying, hey, this note from Dimensional saying, hey, for recessions, by the time a recession's announced, the market's already gone down. By the time the end of a recession's announced, market's already gone up. The market anticipates those, and it doesn't wait around for an announcement. We looked at those huge companies, those big companies before. Dimensional looks at the top 10 largest before joining a company, before it's one of the top 10, the performance, and after. And this is relative to its peers, so this is kind of outperformance. So this is overperforming its peers. This is not a zero here. This is the averages of its peers overperforming. And then once it's considered one of the top 10, not as good. It kind of lags, right? You see this underperformance or kind of flat performance the next 3, 5, 10 years, which is very interesting. I don't know that that predicts what the future is of those magnificent 7 the next 3, 4, 5, 10 years, but it is a very interesting perspective to be aware of. If you don't have, if you haven't looked at the market from now till 1926, it is interesting to add up or stack up all the positive returns compared to the negative. The right in this kind of dusty green is all the positive numbers, 72 years versus 25 years of being negative. Pretty interesting perspective. Now, we've been in this world of talking about recessions, and are we in a recession? Are we not in a recession? How big of a recession? Is it a hard landing? Is it a soft landing? I love that they put this together and looked at the historical performance starting when a recession begins and looking for the next 24 months. And you can see, on average, the market's up about 8.8%. Now, is it always positive? No. 2001, 1937, 1929, 2007, there's been some periods that it had still been negative 2 years later, on average over 8%, which is really interesting perspective. If you're not familiar with OverShare advice and planning, I know we're sending this out to our clients and our friends and our family, so there may be a few folks that are watching this that don't know us. We are a fee-only financial planning and investment advisory firm. We do only fee for service, fully transparent, no commissions. We're celebrating our 5th year in 2024. We're super excited. This year was a big year. We transitioned from TD Ameritrade over to Charles Schwab. As we manage our clients' portfolios, this is how we place trades for our clients, manage their cash, manage their investments, manage their retirement contributions, manage their Roth IRA contributions, manage their required minimum distributions out of their IRAs, and those distributions, their dividends, their capital gains, all that's managed through here. And you can see this discussion of Schwab Alliance, just some screenshots of what the website and the app looks like for our clients. And then, we have a whole access to the Schwab Advisor Center that gives us our Schwab Advisor services, that helps us, dedicated folks just for advisors, to make sure we can serve our clients well. And we're thankful to be a part of the Charles Schwab Alliance and work with our clients there. A few more disclosures as we move through. I told you this, we'd give you some bonus takeaways. It is election time. You're thinking about the election. You're thinking about the markets. You're thinking about, what will I do? Maybe I'm just going to sit on the sidelines. Maybe I'll add some. What should I do? Let's take a look at some history. This may change what you were thinking. It may alter your opinion. Certainly, it's things to think about. Things that make you go, if you remember that. Presidential elections. Does the presidential election, does the color red or blue matter if we look from 1926 to 2022? You tell me. Maybe some areas, but is there a trend? Can you see the difference between Democrats and Republicans now? If we take a look at that and say, the president matters less, it's the Congress. So let's look at Congress and who has control of Congress. Red for Republicans, blue for Democrats, purple for mixed control. Now, if you don't, it's very interesting. I Googled this recently. If you don't know the history of why one is a donkey and one is an elephant, it's worth Googling. It's a very bizarre story of how that came about. But look at this. You can see stocks have kind of tended to reward this disciplined investors regardless of who's in control in the Congress, which is really interesting. Now, if we look even more microscopically, look at the individual month of the U.S. presidential election, the monthly returns, you can certainly see they're scattered across here. This in the middle, this line is at 0, so everything to the right of this line is a positive return, a positive month, and then everything to the left is a negative. And you're saying, hey, the winning party really hasn't been a reliable driver for the direction or magnitude either way in market movements. Be careful if you're placing a friendly wager with your friend. It's hard to really tell. So be aware. Capital Group, if you're not familiar with Capital Group, it's a huge firm, enormous, I don't know, $1-2 trillion in assets. My good friend Jim used to be in California, moved all the way to Austin, like a lot of people. It's a theme of our show. Moved to Austin, Texas, but Capital Group's a very well respected firm. I liked what they put together for presidential elections, and this is more the behavior of investors, and it looks at where are investors putting flows, the net flows, so pluses and minuses. At the end of the day, what did it net out to be? And you see this light blue kind of teal color for money markets, which is like cash. This is saying, money markets is saying, hey, I'm just going to sit on the sidelines. I'm really not sure I want to get in the play and take a hit. So I'm not going to put in this dark blue, which is equity funds. And you can see before an election, this year one, a lot in equities. The year two, a lot in equities. And as we get closer to a presidential election here, year 3 and 4, you can see that balance starts to really shift in that seesaw, and we're seeing a ton more clients put their money into money market as they're waiting. And if we go back to the results here, can we really say that we can predict what the expectation is? And if we look at that month of the election, it's really hard to predict that. But certainly our client behavior or investor behavior tell us that we're trying. We're trying to guess. We're trying to just sit on the sidelines till things figure out. So wonderful to be here with you this time. This was a huge presentation. Send me a note if you liked it. If there's other stuff you want us to cover in future videos, we would love to do that. Happy to do that. YouTube.com/@OverShare Advice takes you straight to our YouTube webpage. Thank you so much for joining us. We are thrilled to deliver this to you, thrilled to be here sharing this. We know we shared a lot. We try not to undershare. What do? We overshare. We want to give you more than you asked for, the advantages, the disadvantages, and trade-offs. Certainly, when we work with clients, we help navigate this for them. We take all of the information that you saw on the screen. They were read hundreds and hundreds of pages to help us navigate for our clients and make good decisions on their behalf. We put a lot of work and effort in because we want to make our clients proud. We want to do good work for them and have good outcomes for them. I know today we didn't share the specifics of our firm views. That's for our clients. Certainly that is for our client meetings that we save that. If you want to hear more about that, reach out to me. I'd be happy to visit with you. But thanks so much. Look forward to seeing you soon.